Now, good evening, everybody. By my time, it's 9:33 p.m. And then I want to say thank you, everybody that is here. If you can see my screen, kindly put yes, why in the chat box. So that will make me know that we all have a one house. Yes, yes, I can see yes, 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 yes. Thank you very much. So I want to say thank you, everybody, for being here this time around again. And then because this is a family time, which I believe everybody has taken a whole lot of sacrifice to possibly make up with. So invariably, I'm going to start this session by just looking at few things. But before I go to the main session, I would like to give you some preamble. Okay. So when I look at preamble in the sense that Forex, what is it actually all about? So the preamble is that this training is going to be ABC of trading, okay? ABC of trading, meaning we're going to start discussing Forex from the beginning till the end, trading. Now, definitely, if you are the kind of person you are here all right. So let me see. Do we have okay? All right, so I think I had some network issue, and I think that is checkmated. If you can hear me and can see my screen, please just put Y in the chat box once again. Y. All right. Thank you for being there. Now, in the basic class, we're going to talk about the definition and we're going to talk about the definition. Okay, let me just make this one. Definition of terms and a simple intraday trading concept plus trading psychology. Okay, let me put this on tips in this regards, but on a basic aspect. So the meat of this trading or session is going to be with the price action, which we're going to introduce under the intermediate, okay, price action. So if you are hearing price action for the first time, you got covered, and this is going to be discussed in detail under the intermediate section. Now, the advanced class is going to be where we're going to mentor you. This is not going to be the kind of session that you will join and then you will be left stranded after few basic discussion on theory. So practical aspect you got covered, okay? Practically, you got covered. Okay, that's it. So on this big session, we're going to take about 6 days to do this, because this is not like we want to take you through a detailed understanding of what Forex is all about. So in the intermediate and the advanced, every part of our lecture is going to take you a period of 7 weeks, okay? 7 weeks in all, okay? Now, this basic, which we are currently starting, is something that you're going to find interesting, and it's going to prepare you to launch into the intermediate and then the advanced section. However, 1,000 miles journey starts with the very first step. So let's begin. Section, slideshow. Now, this program is anchored by GTI in partnership with Infinous Capital. And then I want to say, if you are here for the very first time into this, then I want you to give a whole lot of appreciation to GTI and Infinous Capital for powering these activities. This is a program that is put in place with your interest in the mind, okay? So what is Infinous and what is GTI will be our basic launching into this class. Infinous is founded in 2009 by a highly specialized team of with background in finance, forex, and technology, created to help clients pursue financial goal. Financial goal, how does this really apply? The financial goal in this case, we mean we want you to be successful, hence putting up this kind of training session, transparent access to the forex market with powerful trading platform, namely the MT4, which is everybody, most of us are aware of, and some also aware of the MT5. The CQG is strange, so I'm not going to spend too much time discussing this. If there's anything we pride ourselves at in Infinous is fast execution and speed in line with your trade being triggered and executed in a timely manner. Okay, GTI. GTI is a multinational, let me put it, multinational industry, that is centered in bringing forex to the partner in such a way that education-wise, they want to get it delivered. Aside education-wise, they equally want to make sure that they launch you into is good path where you'll be able to do the right thing. Hence, putting up this kind of session together for your best interest. Okay, everybody that is here, I'm not going to waste too much of the time, and I'll just go straight into our preamble once again. Now, the basic of forex has to do with understanding the foundation of forex, where you're going to learn about the terminologies that you're going to come across with, because when you give birth to a baby, you do not start feeding this baby with bones and gari from the very day one. Peradventure, you start feeding the baby with milk, and then the baby now grow up into taking gari and bones later on in life. So this is our very basic cradle for you to have the full understanding of what you are about to witness in the global industry. Now, before I proceed, I would like to tell you that this is going to be a journey that is going to change your entire life, either positively or negatively. I'm not going to tell you just the good part of trading. I'm equally going to tell you the bad side of trading. But the good news is that we all can have experience with the positive side only if only we decide to do the right thing. First and foremost, it starts with preparing your mind to learn, to explore, to understand, and to be disciplined. Okay, so this is where our discipline begins, and it's going to be more or less like being seen practical by you attending to your assignment as we progress in this session. Now, this is the structure this training is going to be taking. One day on, one day off. Like, for instance, today is Friday. So like tomorrow, which is Saturday, there will not be a session training, but you will be required to attend to some basic assignment, let's say in your off day, so that we will use that to prepare you as to seeing that you understand what we actually put you through. So during the next session, we have a brief recap then before we launch into the next session, and then we all can graduate in our understanding and in our knowledge acquisition all the line. One thing I want to see is that I want to see that along this whole course of training, this possibility of having a negative experience is being mitigated, and therefore we can have fun all the way. Fun all the way does not mean that there will not be a down period. Down period will always be there, but the up period should be more than enough to cancel out the down period, so that at the long run we can stay net positive. Okay, net positive. That is our goal in trading. So this is not going to be the kind of training that you're going to be like, after this training I'm going to be seen to be like trade like a god. Yes, you will be trading professionally, but you're not going to be comparable to a god that created the universe. Okay, now is it? So let's proceed. Let's start with what Forex is actually all about. You will not be able to learn what the business is all about without actually understanding the basic definition and what come up to be look at Forex. Peradventure is, if you open a dictionary and you put Forex, you might not see anything related to it. Therefore, Forex is not just a single term, but a combination of languages resulting from the word foreign and the word together to give us Forex. Now, what is the definition of Forex? I want you to pay attention to some basic terminologies here. First and foremost, I will say the Forex market is a global decentralized financial market where one currency or asset is exchanged for another at a mutually agreed fair value. Okay, fair value underlined. Why? In the Forex market, you either can make money if the market is going up or if the market is going down. Of recent, some of us happen to find ourselves in some investment we do not really understand how it works. Example of which is the cryptocurrency. And a lot of people have talked about, the market is crashing, we are losing money. Who told you should be losing money when the market is crashing? You should be able to make money if it is going up and also when it is going down. Now, for anything that is going up, it can definitely still go higher. Okay, nothing is too high and nothing can be too low, irrespective of the level is currently trading. Okay, now you as a trader, sentiment must be close to zero or not existing at all. You have to be practical and be pure with your application to trading. Now, this is it. Decentralized market means that it is not a market that is located in one area, or which that means you must be able to do only in one area alone. It is a market that you can trade anywhere in the whole world. Now, how do I mean by anywhere in the whole world? You and I do not require any special skill or any special thing to trade the Forex market or any certificate to trade the Forex market, but technically, by virtue of attending this training and understanding what we're going to put you through, then you can start trading going forward. Okay, irrespective of wherever you go. So Forex offers you a whole lot of advantage that has to do with freedom for you to operate your business anywhere you go. I like the slogan of a particular network provider in the country that says, anywhere you go, we are going to be with you. That is just the Forex. Okay, now the centralized market, no particular level area where that is resisted to trading. Now, this, you can trade currency and other assets, meaning that it is not just a market for currency alone. Now, what are assets? Basic definition of economic terms, asset stands for anything that has the potential to return value. Abi, potential, let me see, potential. I think I made a mistake. Sorry, I do not understand too much of English, so I may pardon my error. potential to return value. In forex trading, you don't need to be a master linguistic. All you need is understanding a flow pattern and cycle analysis, which you're going to be exposed to in the later on. Okay. However, you must be able to have a good communication skill, at least for interpersonal relationship. But when it comes to trading, you need cycle understanding and market overall knowledge. Okay. Now, asset potential to return value. How do I mean? So in the market, you do not just trade cash alone. You can equally trade commodities. Okay. What is commodities? Things like cocoa, coffee, metals, energy. So energy, CFD, that means contract for difference. And then let's put indices here. Indices. So aside these indices, I would like to equally put something like aside indices, we can put something like yes, cryptocurrency. Somebody will say, is cryptocurrency part of forex? Yes, they all belong to everything we call the speculative market. Cryptocurrency is equally part of forex. Okay, and then generally we call them speculative products. Okay, we call them speculative products. So your knowledge of being able to analyze the cash or the currency market is equally applicable to other markets. All you need to do is just mastery of the cycle and flow analysis of the particular market. Over time, we're going to talk about discipline and the kind of market to select based on your kind of trader. Okay, now let's proceed. Forex market is the largest and the most liquid market in the world, and it has an average daily turnover of $6.6 trillion as we speak. I mean, not total capitalization. I mean, average daily turnover. The word average means around, right? It could be 7 trillion, it could be 7.5 trillion, it could be 6.1 trillion, it could be 6 trillion. But when you take a mathematical average, then you have a value of around $6.6 trillion. So in case you have studied some book that told you 7 or 5.5 or whatever, we're still having the same terminologies considering average daily turnover. Now, before we proceed, let's take a look at some factors that you will need to put in place or consider strictly before you go into understanding what that moves the market. These factors are very, very important. Sometimes we call it fundamental factors that affect the global market. Example of which are the interest rates, the monetary policy, political instability, import and the export, and then the inflationary index. This is very important. And as well, this one is equally very important. But every factor that I have mentioned here has something interconnected with each other. Interest rates. Investors often want to put money into a market that is paying a higher interest rate. So this interest rate aspect is what we're going to talk later on when we talk about risk of strategy. It's a strategy on its own that you will need to possibly understand. There are markets that never will move in the same direction, and there are markets that we definitely start appreciating at a particular time of the season, and there are markets that we definitely depreciate at a particular time of the season based on sentiment that has to do with the underlying interest rate on the global market space. So for now, let's just leave it that way, that investor will always want to put in money into currencies or assets that can pay higher interest rates. And this is what we call risk on. Then when investors feel like there's trouble in the global world and they don't want to put in money into this kind of asset, they withdraw their money and put it into assets that can protect their investment. They feel like it is not paying too much of interest, but your money is secured. For instance, we've heard about bond market, right? We've heard about treasury bills purchase. We've heard about buying company shares, right? Collecting your dividend and the likes. These are assets that are not paying too heavy interest rate, but these are assets that are not paying too much interest rate, but they can secure your investment without you being scared of any too much of loss. Now, monetary policy. Monetary policy has to do with the Apex Bank money policy at that particular time. For instance, if the Apex Bank is having a good policy in regards to the economy, then investors always believe in that economy and put in their interest. Okay, I will not want to mention a particular country with a bad economic policy, but these are things you will obviously come to understand as time progresses. Now, political instability is equally another factor. If the political atmosphere of a particular economy is bad, then investors want to withdraw, and then the currency of that economy in region also suffers. So also whatever the product that is produced in that economy also suffers accordingly. Now, import and export. A country that has high imports definitely is good, right? Because everything in that country is working well. Job opportunity will be high, goods will be high, product will be available for everybody to buy at affordable price, standard of living will be very good, and this is what attracts investor. But if you meet a country that is importing almost everything, as in including toothpick, a lot of things will be wrong about the economy in such regards. Okay, this is also a factor to watch out for. So this factor will be fully discussed as we progress into our teaching under the fundamental concept. But for now, let's just itemize this point and then go further on. Inflation index is something you can never do without, because it is a measure of the heartbeat of the economy. If the inflation is increasing, a lot of factor is considered to be responsible. And if the inflation is dropping, a whole lot of factors is equally considered to be responsible. Okay, now, market participants. If I want to do a business, I want to know the kind of people that participate in this market so that I don't just go ahead and rubbish myself. For instance, now, in the Forex industry, most of the time, by a chance of 98% from here, okay, from here to this point, this is 98% market participant, 98%. And then from here to here is 2% market participants. Okay, now the banks, example of which are the commercial bank and the central banks, are often the major participants in the market. We equally have the asset manager and the investment bank, like hedge fund, like people that helps to manage investments, registered financial asset manager in the economy are classified under this investment bank. For instance, if you go to the web, you search for mutual Meristem, Covia, you will see a whole lot of investment bank in Nigeria as we speak, and then you can read about what they do and how they do it. These are legitimate fund manager within the country that you can always read. However, the choice of whosoever you want to possibly comply with their investment plan is best known to you, but you should be able to have an informed decision at the end of this session, whether to do it yourself or to put your hope on a third party or an individual out there. Okay, then we equally have the money transfer or the remittance institution. Example I wish are the Western Union, MoneyGram, the tellers. Those are people that help to send money from one country to another country. Why they do that? They equally facilitate the Forex industry. Money is exchanging and from one continent to another continent within a click of time. Okay, we have the edgers, example of which are the bureau de change, the producers, and the miner. These are very, very important. These people, like if you go to our street, you find the bureau de change. Then you go to the market, you find the miners and the producers. Who are the producers? For example, now Nigeria is a major producer of crude oil. Okay, so what we do is when we produce crude oil, we sell to the international market, we earn revenue, we equally get refined products from this. Okay, now in one way or the other, our reservoir is always at risk if we do not participate in the forex market. So if we are having 1 barrel of crude oil in our reservoir, we go to the market, financial market, through the central bank and hedge against 1 barrel. So we do not accumulate any gain or any loss in the storage of our crude oil. If for any reason the price of crude oil depreciates overnight, Nigeria is not concerned by virtue of storing crude oil in their reservoir. Why? Because for every barrel of crude oil we have, we hedge against it in the market. So if the crude oil lose value, okay, like if I have crude oil, that means I have crude oil. Then I will go and sell crude oil in the financial market through the central bank. And then if the crude oil lose value, my physical holdings will reduce in price, but my hedge position in the financial market will appreciate in price. So plus or minus, I risk nothing. So I'm not scared of holding my asset. So the hedgers also, they bring the change in this case. You go to a merchant that sells assets, okay? What it does is it keeps, irrespective of the amount of currency he's keeping, it's not concerned whether the market change price or not. It will only sell at the prevailing price. So how is he protecting himself against market fluctuation in price? Okay, whether positive or negative is not concerned. What he does is for every currency he buys, he hedge against it in the financial market through the central bank, and we classify those ones as hedgers in the forex market. They are not there to make money, but they are there to protect their assets. Now, for this reason, this app has capital protection. Let me say, I will call this one capital protectors. Okay, capital protectors. Okay, now for the other ones, this one I will say banks are speculators. Okay, now speculators in the sense that they are absolutely in business to make profit. They are profit hunters. Okay, profit hunters. Now, profit hunters. Now, I'm sure this is getting a little bit of interest to you. Now, profit hunters are those ones that move in the same direction with the market. If a market is going to buy, okay, that means appreciate to the upside. What they do is that they buy with the market. For example, now, if a product is selling for, let's say, $10, let's say a product is selling for $10, and you have the understanding that this product will get to $25 in no time, what do? You buy. This is $25. So whatever you buy at $10, by the time you get to $25, you cash out. Your profit is going to be $15 in this investment, right? So if you are buying a product at this point, let's say you bought dollar at $10 each. So dollar now gets to, let's say 25, let's say euro now. You bought it at $10. So euro now appreciates one way or the other, maybe over a short period of time, and get to $25. So what do you do to your euro, to the euro you bought here at $10? You're going to find somebody to sell it to at $25. So when you sell it out, then you cash out euro back. At the beginning, point A, you gave out dollar, right? You gave out dollar to get euro, isn't it? So you got euro. So when you are cashing out, you sell euro to collect dollar. So when you're getting that dollar, your profit will come with it, and that's it. So for you to cash out in a market, whatever you buy cheaper, you will have to sell it expensive to get profit. That's how it works. So also, if a market is going down, let's say we are looking at euro and dollar. Now, let's say euro is selling at $25 at this point, and something tells you by way of expression or analysis that this price will get to 10 in no time. What do? Let's say I have 1 euro at this point. What do? I know that euro is going to depreciate. I'm going to sell my euro and realize $25, 1 euro. So by the time euro drops to 10 at this point, what do? I'll go and use 10 out of the $25 I realized at point A at this point to go and buy back my €1 at this point, then my profit is going to be 15. This is how it works. So how do you know whether you want to buy or you want to sell? This is the reason why you are in this class, okay? So let's progress stepwisely. Now, like I said, these are 2% market participants in this market, the forex broker and the retailers. Somehow somebody will ask here and say, do forex brokers equally trade forex? Yes. When you deal with bad brokerage firm, example of which we'll call the dealing desk, they equally trade against their clients. Okay, so this trade actually constitute part of less than 2%. It's always there, is rare, but they are not, it's not like they are not existing. Brokers equally trade against their clients. These categories of which we call the dealing desk. So as time progresses, we're going to talk about the choice of brokerage and what dealing desk broker also stands for. So sometimes we call it the market makers. Okay, market making brokerage firm. Most of the time they don't have license. They trade against their clients. Okay, sometimes they throw spikes, sometimes they throw a whole lot of tantrums to just achieve this purpose, and sometimes they equally trade, but invariably this effect is always very minimal in the forex industry, and it's not a general practice that is illegal. Okay, they trade illegally under this condition, whereas you equally have some brokerage firms that are straight through process. We call it STP, and then we have what we call the ECN, that is electronic communication network. These are often licensed brokerage platform. They don't trade, and it is not allowed for them to trade. Parabesho, you know that my name is Tijani Latif Bemiga. You would have heard about a particular product we call social trading community, known as IS Social. More than often, a lot of people have asked me why I am not on that platform. The reason why I'm not on that platform is that my regulation is completely against being on that platform as an individual trader. Otherwise, it's going to be a crime. Okay, that's just it. It's not like, but one-on-one, you meet me, I'm going to make you smile sincerely. Now, retailers is you and I in the sense that people who possibly have lesser capital. What we contribute into the market is less than 1.something%. Our position is very minute. Why is the knowledge of participant ratio very important? Because on the day the banks, which are the major players, and the investment banks are on holiday, market is often considered to be low volume. And when you see the banks are on holiday, it is equally a day for you to go on holiday, because usually these people cannot move the market as it's supposed to be moved. So you want to equally know the day you should not be looking at the market at all, the day you should take break. Look for the day the banks and the investment bank and asset manager are completely on holiday. This will become known to you as we progress in our knowledge in this business. Okay, now, what do you need to be a trader? For every business you want to do, there must be a basic requirement that you must have to be able to be eligible. Sometimes it could be very easy, sometimes it could be very tough. When it comes to the ease, that is what Forex stands for. What you need to become a trader does not go beyond having a laptop or a computer. And if you do not have a laptop or a computer, having a smartphone that has internet connectivities is all that is required. Plus, a choice of a very good broker, which Infinos can actually give to you, and then a very good education in place, which GTI is already bringing your way this time around. I want to say this is going to be a family house in the long run, and the journey is going to be very smooth all the way. Okay, startup capital is very important. I always emphasize on startup capital. Please, one thing you must never do in forex trading is to trade with a sacred money. The word sacred is very important to me. Sacred stands for, one, Never borrow money to trade, because your mind will be on the money, not on your trading. It will trigger your emotional traumatizing effects. Okay, no, don't borrow money, and don't invest your school fees. Don't invest your rent. Don't invest your ed bill, because whatever you want to put into forex, it has to do with something that you can deal in the market with, and you will not be emotionally attached to it. So your reasoning and psychology will not be impaired in any means. So more than often, I always advise that startup should be in respect with your savings. Savings in the sense that, let's say you have $100,000, $100,000 in your account. You have 100,000. Let me say you have $500 in your account, and you want to start trading. The question is, how much of this $500 should you invest? I always advise not investing more than 20% of your capital. Yes, 20% of your capital. Don't go and borrow. Don't go and break the vault. And then you might say it's too small. Yes, the Bible says, despise not the day of little beginning. One thing that matters is your skill, understanding, and your technical know-how must be must be of top notch. Then I can guarantee that in no time, this 20% that you are starting your business with will be what that will pay your overall bill, if only you can put in what it takes. And it starts here now. Now, let's proceed. What are the advantages of trading forex as against other markets? First and foremost, the market is available for you to trade from Friday night. Let me say, like now, today is Friday. The market is obviously closed. So the market closed 10 p.m. on Friday and opens 10 p.m. on Sunday, right? So outside this, the market operates round the clock, right? Just like that. Okay, let's say the market 10 p Friday to Sunday. So like this. So it opens on Sunday 10 p.m. and closes Friday 10 p.m. So Saturday and Sunday is not available for trading. It is not like the market has closed on Saturday and Sunday. It is the brokerage platform that is not available to be traded on Saturday and Sunday, because it is considered a resting day, a server reset, a upgrade time for the platform, okay, to at least undergo upgrade, isn't it? So market is often considered to be not available on these days. Now, also, if you understand, most banks don't operate on weekends. So if the banks do not operate on weekends, and I said the banks constitute 98% of the time, so most than often the weekend volatility is equally very, very minute, and you might not find any meaningful move during this period. However, sometimes in some occasions there will be move and the market opens with a gap. Okay, we're going to discuss these conditions as we progress in this session. However, if you want to see, if you look at some other markets using the indices, we have a particular market that they call the synthetic index. It operates on weekends, and the crypto market equally operate on weekends. So it is not going to be completely out of norm to say the market never sleeps. Money never sleeps. Okay, so if you understand your trading very, very well, irrespective of your day-to-day activities, you can still create a strategy that will meet up with the round-the-clock transmission of the market. So let's say, for instance, you work actively during the day in your job, and then you still want to trade maybe in the night. The market is going to be available. Let's say you work from Monday to Friday, you only have weekend to trade. The market is there for you to trade. All you need is understanding of how to trade. Okay, so you can still keep your day job and still be a profitable trader, irrespective. So, and also, if you have all it takes, you can be a full-time trader without any job. Yes, it has been like that. I've traded full-time for over a long period of time, and I am a living testimony to this. Okay, I did nothing with trading as a particular time. So when I talk about being a full-time trader, what does it entail? Does it mean that you want to be trading, you must be in the market 247? The answer is no. So as a full-time trader, you could either be trading, you could either be teaching, you could offer a financial advisory service, like somebody wants to buy crude oil, somebody wants to buy cocoa, somebody wants to buy cashew, somebody wants to buy cereals, somebody wants to buy the CFDs, whichever. I can give financial advisory service. So it's not like you are giving signal. It's not like buy, signal is when you are talking about financial advisory service, you're talking about doing this on a professional level. Then you can facilitate. Then you can be a fund manager. Then you can equally be a prop trader. Okay, I'm going to talk about this as time progressing. So you can be a prop trader, as in managing a third party fund, but under a professional scale where the risk is transferred out of your own proportion. Okay, you can be a fund manager where you take responsibility for every asset that is put in your care. Okay, I think I made spelling error. Facilitate, because a lot of people might want to go over this video later and then it will be like, what is happening here? So financial, we talk about financial, okay. Now, financial advisory, teaching, and trading. These are things you can do on a large scale. And then aside this, you can equally do trading and get employed in banks. Most banks are now looking at having a professional trader in their foreign business operation department, and this is something you can always get to be at least eligible for if you have the basic and the full understanding of how trading works. So what you do with this knowledge that you're going to be having is not just limited to just buying and selling and then that is all. You can decide the kind of business you want to do with this information at long run, and what you do is your own, is best left to you. But one thing I will guarantee you that all the way, irrespective of how you want to expand this teaching, we're going to be there with you. Infinos and GTI, that is what we can always guarantee you. High liquidity with over 6.6 trillion daily turnover is what that ensures that if you want to buy or sell any asset, you do it with a click. So since the market has a very high liquidity, executing any particular position takes seconds, microseconds. You don't have any waiting period. So it's not like any market that you want to sell, you have to start looking for buyer. Buyer is already waiting. And most times the bank has enough capital base to absorb any order you want to send in, and equally the banks can equally give you any asset you want to buy. So the risk of, I want to sell my dollar, where should I go and sell it? Who should I sell? No, just open your laptop, do the click, and that settles it. I want to buy my dollar. That's it. But in Forex, the question is, do we buy this? When we buy, do we wait for a delivery of whatever you buy? No. The answer is total no. What we do in Forex is that we trade the financial value. We trade financial value of assets or cash. So we don't receive physical delivery. Rather, we exchange the financial value over a period of time, and we make margin gain if we are right, then margin loss if we are wrong. So you want to be right most time, isn't it? That is why you are going to be learning this business. Now, better risk management due to leverage. This is very important. The question is, what is leverage in the first place? Leverage to me means boost, right? If leverage stands for boost, that means leverage. That is when you say you leverage or something, you are boosting your capacity. So in Forex business, the term leverage means that when you deposit a particular money, your broker gives you a kind of capital boost so that your purchasing capacity is enlarged, and then you'll be able to deal like you are bigger than your worth, and therefore you'll be able to make a reasonable execution and then get reasonable profit. However, if you are using leverage, you must have a basic understanding of trading for you to be profitable with it. Otherwise, leverage is going to expose you to some risk. We're going to treat leverage later on as we progress. Low cost of transaction. Yes. For every business, let's say some of us that have stock, but when we want to buy shares, we'll buy shares, we'll pay management fee, legal fee, all those fee we pay before we can execute our asset purchase in the other market. But in the Forex, nobody pays that kind of money. All you paid is just the spread. Spread means stands for the cost of execution on any particular trade, and it's a one-off. More than often, this is less than micro percentage of whatever you are buying. So, for example, now let's say you want to buy an asset that is worth $100,000 in the Forex market. Your spread ordinarily will not be up to $20 in this regards, and then you can compare the percentage of $20 relative to $100,000 investment. However, if you try this $100,000 investment in other markets, you might be paying up to 2.5% of your investment, and that is going to be huge depending on the balance in this regards. Low barrier to entry. You do not need any special certification. You do not, after this learning, nobody will tell you you have to pass one exam to be a trader. No. Once you gather what it takes, then you can launch your path and you can fit into the business under this basic category. Okay, under this basic category. The ultimate is when you have the full understanding of Forex and you can gather enough capital, you can have your home brokerage firm, right? And that is the bigger part of it. You can have your own proprietary trading firm. You can have your own, whichever you want to have. Just the goal is now left to you. No certification is required to this. You do not need to get a degree. You do not need to have a master, whatever. You just need to have understanding of how the market works, cycle analysis, price action, and then your timing must be very, very factual. Now, this is it. We progress a little bit. I'm going to take this because I want it to be very in-depth. Hence, I'm not going to be like wasting too much of time on any of these concepts. So the next one, we go to market session. Majorly, we have 5 types of market in the world. We have the German, we have the London, we have the New York, Sydney, and the Tokyo. And these markets are different, operate under different continents, and therefore they have different time zones that they open and close. Of course, you know that in Africa, West Africa here, our timing zone is more or less like GMT +1. But if you compare that with US, which is 6 hours behind, that means you will see that sometimes when we are in the morning, the US is in the night, and therefore it is not always going to be the same time that the market will be open everywhere in the world. This has to do with what we market is structured in such a way that there will not be any particular time that the market will be completely closed. More than often, you will want to see that you understand to know the right time of the day to execute your trade. More than often, that's what we call DMT offset or DMT, daylight shift saving time. So this daylight saving time also can change this timing. So you need to be able to keep yourself abreast of this information. For this change, I would like to say you can visit a particular website. So on this website aspect, I will go to the web page. You can just go to Forex Time Converter, Forex Time Converter. So when you go there, you just scroll down, then you see Forex Time Zone Converter. So this Forex Time Zone Converter, if you scroll down, you will realize that this is it. You realize that the market, this timing is Lagos. This is the website forex.timezoneconverter.com. So currently the timing is 10:22, which is Lagos time, and you can see all the markets are closed. But I want you to understand something. We have 5 basic markets in the world, and the time zone differs. The time of open is indicated and the time of close is equally indicated. But one thing is this, irrespective of this time zone, we have what we call session, and the condition for which we classify session has to do with any market, irrespective of the location where it is in the world. If it opens within a time difference of less than 2 hours, okay, we consider it to be one zone. Therefore, the German market opens 7 a.m. GMT +1 time, or let me say Lagos time, and the London opens 8 a.m. London Lagos time. So these two market opens within 1 hour difference. So we classify these two market as one and call it London session. Okay. If you look at the New York market, it opens 1 p.m. Nigerian time. And if you look at it, it is like 5 hours away from this. So this one will stand on its own and we call it the New York session. However, the Sydney and the Tokyo market opens an hour different from each other, 11:12, right? So we call this two another one, which we call it Asian session because it falls under the Asian time zone. Now, this is it. So invariably, we have what we call the London session, then the New York, then we have what we call the Asian session. Now, we've been able to merge market together and classify them into session based on the time, proximity of time of opening in this market. But if you take a look at something, you realize that between the hour of 8 o'clock, this second market opens, and 1 o'clock, by 1 o'clock, when the New York market is opened, the German market, right? The German market, the London market, and the New York, because the German market closed 3 p.m. So it's equally add to the New York market. So by 1 o'clock, 3 markets are all open at the same time. Okay. So by 1 o'clock, 3 markets are open at the same time. So here you have 2 markets, here you have 3 markets, and here you have just 2 markets opened. So let's put numbers to this. You have 2 markets, you have 3 markets, then you have 2 markets open at this point. Now the question is this: when is the best time to trade? The best time to trade is the period of the day when 2 or more markets are overlapping. That means when the volume, because that time the volume of the market will be so high, right? If the volume of the market is high, then that is the best time to trade. So more than often, the best time to look for trade is between the 1 Lagos time to 2 hours into New York, 1 to 3 p.m. Why? Because this market is still operating till 3, and this one is still operating till 4. So by 3, it will drop from 3 to 2, right? So this is the best time when to look for the trade in the day. And then the best time to trade is 8 o'clock in the morning, because by 8 o'clock, 8 a.m. to 10 a.m., which is 2 hours in the morning, the market volume is equally 2 times high, right? So invariably, best time of the day to trade is from what? We can just say, okay, from 8 a.m., because 2 markets, which is London session, has opened, to 10 a.m. in the morning. If you cannot find trade setup within that period, then you don't waste your time. Come back in the afternoon. The afternoon is 1 to 3 p.m. in the afternoon. This timing is what we call brink period. Brink period. Brink period. We call it brink period in Forex. Brink period is we call it brink or peak. Okay, we call it peak time. Okay, we call it peak or brink. Let me put it in this case, brink. Okay, so I'm sure you're getting some points. These are so the question is, do you need to watch the market 24/7 from morning to night for you to find a trading opportunity? The answer is no. Right? The answer is what? Is no. Right? So if the answer is no, so what time of the day should you be looking at trading opportunity? This is what we have stated. This is the peak period for the day for you to come and trade the Forex market. So more than often, if the GMT offset change, the timing will equally change. But you can always know this by revisiting this website anytime it opens. So now the entire market is closed. So everything is closed for the week, right? So everything opens again from Sunday night, because the market is now available for Forex and the asset market on the weekend like this. Something equally is important. Between the hour of 9 and 11, that means from 9 o'clock, the New York session will close, but no market is open between 9 and 11 o'clock every day. So when you look at this 9 to 11 o'clock, it's what we call the dead time. Dead time. Look at it very well from here. You see that when this market closed 9 p.m., the next market that open 11 p.m. So between the hour of 9 and 10, no market in the whole world is open. This is the time of the day the brokers often manipulate trade. This is the time of the day the brokers that I call the dealing desk often manipulate trade, because it is called the broker's time. This is equally the time of the day that brokers, the market often pay what we call swap. You know swap later on. That is when you buy asset that has high interest compared to a low interest asset, you're going to have positive swap. And when you do the opposite, you're going to have negative swap. This is the time of the day that swap is being paid. This is the time of the day we call the crossover period of the day, between the hour of 9 to 11 p.m. Manipulation often occur in the market. So what do you do around this period of the day? As a trader, I've often advised that if you are an intraday trader, make sure that you do not have any position or execute any position, because at this time, spread is often high on any broker, first and foremost. But bad brokers throw spike during this period of the day so that they can trade against the traders and take them out of position. These are time of the day you don't want to trade. Pick this thing. So you have seen two different categories: dead time and then the brink time. Dead time is don't trade. Peak time is look for trade. Now you get it. So let's progress. So in line with our progress, current slide, and then so with this, I think we have explained this and how it's applied to our trading using that website. So let's take a look at this chart, and then we'll be able to see the significant effect of this session on our trading. So if you take a look at this box, the first box in here is the one that depicts what happened in the Asian. Now, taking a look, the size of market movement within the Asia session, you can see that it's small. If you look at what happened in the London, this is the London bourse, okay? The size of market movement in the London, you can see what it is. You can see that it's big. So the bigger part of the market movement often happen within the London and also the New York. However, if you take the one that happened in the New York alone as a case study, you see that the largest move is within the New York. Now, this is it. This is what happened only in the London, and this is what happened only in the New York. When you combine these two together, this is the bigger structure. You see that the major move is happened in the New York. So this is a 3 markets overlapping, and this is a 2 markets overlapping, and that settles a whole lot of things. So you can see this. So if you miss trading opportunity in the morning, you possibly can see a better opportunity in the afternoon. Don't chase the trade. You will see this as we progress in our understanding as time goes on. Now, when to trade the forex market, we have just explained this in our last slide. Between the hour of 8 till 10 a.m. and then between the hour of 1 to 3 p.m. Monday is often considered to be a period of consolidation, so you don't want to trade. And then Friday is a period of the week that manipulation is often occur because of book balancing or from some other hedge fund and financial institution. You don't want to trade. But let's say you want to trade on Monday. Since volatility is low, you want to reduce your expectation. And Friday, you want to increase your, you want to reduce your expectation on Monday, and Friday, you want to limit your risk to avoid being manipulated upon, okay? Now, let's take a look at this. What is a risk? What is a risk? To me, risk is the possibility of making a loss, right? Possibility of not making profit, right? But it only comes if you do not understand what you're doing. You understanding what you're doing is a very, very basic concept you have to put in place, okay? The very basic concept you have to put in place is understanding what you're doing, okay? So at this point, I would like to just take us to basic terminologies that we're going to be coming across as we progress in this teaching, okay, and in our dealing. But we will not progress without understanding what currency and currency pair actually stands for. Usually, The currency can be defined as a medium of exchange that is regulated by the apex bank of the country you are dealing with. Okay, the apex bank means the central bank, the highest bank within the country. So in the world, we have majorly three types of currency, which are the major currencies. Then we have the minor currencies, and then the third one is the pegged currency. The pegged currency are of no financial value because it does not change. Example is Naira, NGN is fixed at $4.11. Okay, so if it is fixed, it does not have any financial value, so we are not considering that. So we don't just consider the major and the minor. So what conditions are put in place to classify in this classification? Conditions are: one, you want, if any currency that is traded above the threshold of $1 billion per day, then that currency is considered to be a major currency. At the moment, we have 8 major currencies in the world, namely the American dollar, British pounds, euro, Canadian dollar, Swiss franc, Japanese yen, Australia dollar, and then the New Zealand dollar. Now, these 8 currencies are considered to be the major, but the biggest, the main one is American dollar, because almost every country in the whole world has their foreign reserve denominated in dollar. Okay, so the dollar is considered to be the global currency. Okay, global currency. So the volume of trade in dollar related assets is huge, and it is the biggest in the world. Now, followed by the other ones. Now, this is it. When you do this, when you understand this, and then what then is the classification for the minor currencies that are traded below the threshold of $1 billion per day, isn't it? That settles it. So in this case, example of which are the Mexican peso, Swedish krona, and then the South African rand, ZAR. Yes, the question is, do we have South African currency tradable in the forex market, and we do not have Naira? Well, yes, yes is the answer. The South Africa currency is traded in the forex global market. Even this Ghana cedis is equally traded in the global market. Perhaps the government policy believes in the market, the forces of demand and supply than some other on the industry. So now let's take a look at the major pairs. Just as we have the major, the major and the minor currency, we equally have pairing. Example of which are pairing that combine any of the currency with USD are considered to be the major. And then, so for instance, if you take a look at, just add any currency in the world and combine with American dollar, it is considered to be a major currency. So if you take a look at this, you see that we're talking about assets like Euro USD, USD CAD, GBP USD, just anything X dollar. Let me see. Let me put it X USD or USD XXX, meaning that anything you combine with dollar becomes a major. Now, what are cross pair? So when you pair anything among all these major with excluding dollar, you have a cross pair. So you bring GBP and Euro, you have a major. You bring Canadian and you have this. Now the question is, what the third category is exotic. For exotic currency pair, I would like to give a warning at this point. Please do not participate in trading the exotic as a beginner. One, the spread on them are high. The cost of execution on them are high. Manipulation on them are often equally very high. Sometimes you cannot predict their volatility, okay? Because the prevalence of manipulation on them is excessively very high. But sometimes trading them can be very profitable. They can have a very huge move intraday. So when you have a mastery of understanding, you can therefore proceed to add all these exotic as time progresses. Okay, so you don't want to start your trading career by just looking at the exotic. So very invariably, in the course of this trading career, you will have to on the majors currency that appeared with dollar, not for anything, but just for the basic understanding that I want to concentrate on just the major. So this will help us with our notation and our position as time progresses in the course of this section. Now you want to look at basic codes. Okay, so this class is going to end on this basic terminology aspect. Then tomorrow we're going to start with how, on Sunday we're going to do how to trade. This is where perhaps it will be like when the market has opened, so we can execute trade. So it's the best time to see how to trade. So today we conclude this session by looking at our basic terminologies and then launch our path towards understanding any other thing later on. So the base and the counter currency is very important. In Forex, Forex is traded in pair. Why? Sometimes somebody will say, trading the currency market, somebody must lose for you to make profit. The answer, that is a wrong assumption. You do not have to lose, or nobody have to lose for you to make profit. What happens is that the profit you make from trading originates from capital loss from other financial markets. Wait, let me see. Do I have a network? Okay. Now, in the forex market, you trade the economic value of one currency over the other. So the currency under the base, which is the very first one that is written here, this currency at this point, okay, and this currency at this point. The one that is written first is considered to be the base, and the one that is written second is considered to be the counter, okay? So if for any reason you want to, you're having a trade, now you are trading the economy of Europe just by making a click on the need to either decide to buy or sell. So if you feel like euro is going to appreciate and dollar is going to depreciate, what you do is you buy this currency pair, euro USD. So America will lose value economically, and then the Europe will gain the value economically. In this case, there will be value flow from American to euro. So you investing in economy of euro, you will have capital appreciation, which will now become the profit that you will make in this market as it all progresses. Okay, so it is not an individual that is paying you the profit you make, or it is not an individual that is taking the loss you make. It is the economy of the country that you are trading their investment that is going to make it. So it is their economy that is going to pay. So plus or minus, whether I trade or I don't trade, you will still be able to make profit if you have the right understanding and execution in place. Okay, so now when you have this asset, so the first currency that is written here is called the base, and the next one that is paired with it is called the counter. So invariably, if you look at trading per se, you might have a view like it can be written as USD, euro. In this case, you have reversed the base and the whatever. In this case, USD becomes the base and euro becomes the counter. Whichever the currency, the one that is written first is considered to be the principal, which is the base, and the one that is written second is called the counter. So when you have the quotation written as the exchange value is equally quoted, then this becomes a quotation. You have the pair and you have the exchange rate. Pair written together, that is a quotation, and that is how trading is done. So some brokerage can put iPhone in the middle, can put dash, and can write them all together without any separation. It's still going to be the same thing. So you don't get worried or confused when you are seeing this different notation. Okay, now in the forex market, there are two basic markets which are called the bid and the ask price. So the first is, what is a bid? Now, the bid is the price a market buy. The price the market buys appears on the ask. The bid is the price a market buys a pair or an asset. Therefore, trader sells at the bid price. Then in the other way, trader buys at the ask price. But more than often, the ask price is always higher, little bit of differences in this value than the bid price. For instance, you want to go and buy an asset in the market, and one way or the other, the trader tells you this thing is sold for $100, and then let's say you have paid, and then you make your mind, you now change your mind that you are no longer buying again. If that person will collect that goods, it's not going to give you $100. as long as he has issued you a receipt. Now, this policy is what we call pricing, and this is the same process that is applicable in the forex industry. This difference in the bid and the ask is the cost of execution per every trade, and this cost per execution is always given to the broker, and that is where the broker make their own money. Okay, so now for every market there will always be a tick. Market can either tick to the upside or tick to the downside. When it ticks to the upside, that is appreciating. When it ticks to the downside, it's depreciating. So when it keeps ticking to the downside, you want to be selling. If it's ticking to the upside, you want to be buying. Okay. Now, this tick in the market has its own particular terminologies, and this is where pips comes in. So what is a pip? A pip stands for percentage in points, and it is the measure of the minimum tick in the market at a particular time. Okay, so when you're looking at a market tick, you say the market has moved 1 pips, either up or down. So we don't say the market is ticking. We don't say this is ticking. We say the market is appreciating or depreciating in pips value. Okay, so now this will become clear. So now the difference between the ask and the bid is called the spread. This spread is what we call the cost per execution, cost per transaction on every trade you do. Whether the trade become profitable or not, your brokers will take this spread. So you need to be very careful before you just make click. This trading is it's not a business where you just have to make click. Every mistake you make at your trading desk will cost you money. And then, but in the meantime, while you are learning, there is a good news which I want to let you know. You have a reason to have up to $100,000 account, which is called demo account. This demo account will help you to get acquainted with how to maneuver the trading platform, how to place trade, how to master trading, as in the usage of the trading platform at large. But when it comes to real learning of trading, no matter how small, you need to put your blood on the line. You need to test your emotion. You need to test your perception and your psychology with at least something small. Then over time, your confidence will build along the line. Now you can see the graduation. You graduate from learning, mastering the usage of platform and understanding terminologies from the demo platform. You can open as many as possible demo platform. Mind you, you don't need a computer. Most time you can do this on your phone, and this is where the beauty of Forex comes in. Freedom, I must say, is all you get in abundance. Now, that's it. So now let's proceed here. PIP, percentage in point. We've just discussed that. And then there's also a fractional PIP, which is called pipette. Pipette stands for 1/10 of a PIP value. So now let's take a look at this notation. When you look at the chart, this is what you're going to be seeing. Let me take you to the chart so that you possibly will not just look at it on a theoretical value point. So I'll just go to Euro USD. I'll go to template, shockboard, this, reset, set. Now, this is what your chart will definitely look like. Control Y. This is what your chart definitely look like when you start up with over. I'm going to take you through the basic understanding of charting as we progress, but technically, first and foremost, you have to remove the irrelevant things. Example, you just press Ctrl G, the grid line on this chart will disappear. Now, once you press Ctrl G and the grid line disappears, now there's what we call this, which is Alt T. Now you can see that the value for this asset has just popped up. Now this is a sell button and this is a buy button. Unfortunately, the market has closed, so we cannot execute any trade at this time of the day. But I just want to show you something. Now, if you look at this, this is the bid price and this is the ask price. In this case, you see that the bid price, the ask price is actually higher than the bid price. And then the fourth decimal figure here, let me put it in this regards, which I'm going to say at this point here. This one is your PIP value, and the superscript at this point is your pipette value. So if you want to look at this, so you buy at this price and then you sell at this price. But if you buy at this price immediately and you sell at this price, you are going to be losing some money. The difference in this is called your spread. And then how do you calculate it? First and foremost, start by saying 8 minus 5, that is 3, right? You write it. So that will be 3 pip. 8 minus 5, that is 3 pip. Now, then 5 minus 5, that is 5 minus 5, that is 0 pipet, right? That is 0 pipet. Now, this is 0 pipet. Make sure that this means that if you convert to 0 divided by 10, it still be 0. So you now have 3 pipettes as your spread in this case. Mind you, the spread you have on the weekend and during the dead time when all market is closed is not real. Do not, since you cannot trade, so you don't need to bother. But you only measure the true spread of a market as it is only when the market is active during the time period of the day. But usually this is often between 0.5 and then 1.2. Okay, it's not going to be more than that. So whatever you see on the weekends or during the dead cap is not really a real spread value. Okay, so now with that settled, this is the pip value and then this is the pipette value. I just want to see this on the chart as it is here. So let's go back to our notes so that we can conclude this session for today without having to make this class too boring and monotonous. So current slide, that is just it. Pip value and pipette value. Okay, that settles that. Spread, we have just sorted that. Spread is the cost, cost of execution per trade, and it is a measure of the difference between the ask and the bid. Now, spread can be defined as the fee for creating a dealing desk for trader by execution. Okay, so leverage. Leverage the other time, like I said, when I was talking about the advantage of trading, I said leverage is a boost, a multiplier, a boost and a multiplier on your account. So leverage is measured in ratio. So let's say somebody has a leverage of 1 to 50. 1 to 50 means that your purchasing power is going to be multiplied by 50 on any deposit you make. So let's say you have leverage of 1 to 500. This means that your purchasing power will equally be multiplied by 500 times. So the higher the leverage you are using, the higher your purchasing power. So for somebody that wants to buy an asset worth $1,000, okay, and your leverage is 50. So it means that you need $20 to be able to trade, isn't it? For somebody that is using 500, you need just $2. So the higher the leverage you are using, the lower the amount you will need to contribute to for you to trade effectively in the market, right? So now the question is, this amount that is required for you to open a trade is as the special name in the forex industry, and this is what we call the margin required to execute. Now, the higher the leverage you use, the lower the margin, and the lower the leverage, the higher the margin. Invariably, I'm saying the higher the leverage you use, the smaller, the lower the amount you will need to put in place to execute a trade. Okay, and that is key. Now, that's key. So now let's take a look at that is margin. What is a margin? Margin stands for the value of your equity that is required to open a position, and we have talked about how it is related to margin, to leverage. Margin is inversely proportional to leverage. So invariably, that settles that. When we talk about money management, I will come back to this margin and leverage again when I'm going to talk about balance breakdown. Okay, so lot size. What is a lot size? Lot size simply means contract size, and different lot size in the market has different financial value and financial implication on your trading. Standard lots, mini lots, and micro lots. For micro lot, that is $1,000 contract. The standard lot size starts with $100,000, and then if not because of leverage, majority will not be able to trade at all because only a few can possibly put $1,000 in place. And if you have $1,000 in the market, that means you are going to be risking 100% of your investment on one trade, and that is not a good one. So it is because of this level that brokers are giving to us that makes us to be a good player in the market today. Otherwise, we do not stand a chance. Now, others, I'm going to stop here today, and I'm going to spend the next couple of 7 minutes to welcome question and answer from all. So please, you are in this class, you've possibly listened to me and you do not understand something, just raise up your hand in the chat. Let me see the chat section, and then, okay, I'm having bad network. Wow. Okay, please, I will get the record. Yes, the record will be made available to all. Thank you, Infinos. Thank you, GTI also. Thank GTI, thank Infinos. Okay, thank you everybody for being here. You have any question, just raise up your hand, or let me say, I want to unmute everybody so that we can have this. Now, this type of order will be taken on Sunday because I would like to do a practical presentation. Now that the market is closed, we cannot do placing order because this should not be just end as a theory. It has to be practical, and this involves practical, so we cannot do orders today. So this is where we're going to end. So thank you. I would like the recording. It will be available after this. Just contact GTI. The recording will be given to you, and so that settles it. So you have any question you want to ask? You've been unmuted. Raise up your hand. Mr. Henry Ani, you can now talk. Raise up your hand if you have any question. Henry. Onwuzurike Infai. Okay. All right. Hello. Yeah. Infai, you have the floor.
Okay. About this,
Hello.
the preview value and the spread. Is it through the spread I used to? Hello?
I can't hear you
Is
clearly.
it using the spread I used to calculate the PIP in profit and loss?
No.
I said, is it through the spread you used to calculate the PIP and loss?
I can't hear you clearly. Can you put it in chat box? Like network is a little bit down over there compared to what I can hear well.
Hello?
If I can hear you well, you mean, do we use the spread to calculate the pips?
Yes.
No. The spread is measured in pip. Okay.
Now you are minusing the distance from the.
Now this is it. Let me take you back to that level. I said this is, let's say this is something that we have here. Now this is 1.10255, Abby. This is 1.10269. Now this means that this 9 is the pipette value, and this 5 is the pipette value of the bid, and this is 9 is the pipette value of the ask. So 6 here is the pip value of the ask, and this 5 here is the pip value of the bid. So if actually if spread, let me say spread equals ask minus bid, right? Okay. Therefore, this what you have here is what you're going to be subtracting from each other. Then you're going to be working with these last two and also these last two. So in this case, now here I have 6 minus 5. So this is the bid, the ask, Abby. So 6 minus 5 will give me what? 1, Abby. 6 minus 5 will give me 1 pip, Abby. Then 9 minus 5 will give me 4 pipettes. Right? Now, if I'm to add this together, I'll first convert this pipette to pip. So this one will now give me 0.4 pip if I divide it by 10, right? So in total, I have 1 plus 0.4. So total spread will now be 1.4 1.4 in this case, pip, and this will now become my spread. This spread is what the broker will take as cost of execution on this trade. So sometimes, depending on the lot size that I'm trading, if I'm trading a standard lot size, this will become 1.4 times 10, which will become $14. $14 for $100,000 investment that I have executed. If I'm trading a mini lot size, which is this one, will become $1.4 for a $10,000 investment. If I'm taking a micro lot, this will become $0.14. Okay, that means the contract side that I'm buying with this spread value will determine what the exact amount will be on my account. Okay, so it is this is just the basic spread you pay. So the amount that this will become will be dependent on the contract size you have. I've not gotten there because I don't want to make it look complex for the beginning. So just let us understand how to get the spread value from taking the difference between the ask and the bid. And that is what I just did the other time. It's not like pip equals to spread. No, spread, any in the market, any tick in price, any difference in price, any change in price is measured in pips. So everything is quoted in pips. Just as meter is used to quote anything that is measured in length, so also pip is used to quote anything that is happening in the forex market. I hope that is clear. Mr. Ifeanyi, does that answer your question, sir? Mr. Ifeanyi, does that answer your question? So who else has a question here, please? All right. Thank you very much, everybody, for being here. I really appreciate. And the video of this presentation will be sent to GTI, so you possibly can have a copy of it as soon as this meeting is over. Let's say tomorrow, just contact GTI, you'll be having it. So on Sunday, we have a continuation of this, and then we will go into how to trade properly, how to analyze the market, how to come up with a decision to buy or sell or any particular product, and how to choose your market. This will become a basic foundation, and then we will graduate along the way as discussed. So tomorrow, you have any question, I'm not able to attend to it during this presentation, please just ask in the group. That's I think the group is Free Forex Training GTI, whatever. So let's say free. Okay, this is the group here. So join this group. Let me just get the link to this group so that you can have a very big house to do this. So the link to this group is okay, I think, okay, I'll just get it. Just search for July free MJ training. Okay, just put it in the group and then search it on Telegram, then you'll get it, or contact MJ Young and then it's going to send you the link to join this group. Mr. MJ, if you are in the house, please, can you help me to get the link to this group and share it in this meeting, please? Mr. MJ, do I have MJ here?